Welcome to the Tesla Daily News podcast for December 15th, 2025. I'm your host, and today we'll break down the latest developments that matter for Tesla investors, including troubling sales trends in the US, fierce competitive pressures, new manufacturing moves, and what these stories mean for Tesla's growth, margins, and stock price. Here's what you need to know about Tesla today. Let's kick things off with a big story for investors, a steep drop in Tesla's U.S. deliveries. Despite aggressive price cuts for the popular Model 3 and Model Y, November sales came in at just under 40,000 vehicles, down around 23% year-on-year, according to Cox Automotive and Reuters. This marks Tesla's worst monthly sales result in the U.S. in over 3 years. The context: Tesla slashed prices hoping to sustain demand, but the real culprit seems to be the phase-out of federal tax credits. With incentives gone, consumers are hesitating, and Tesla's swift top-line growth is hitting a road bump. For shareholders, this raises concern about Tesla's ability to defend its U.S. market share and maintain unit margins as competitors, especially Chinese EV makers, keep scaling up. Bottom line, watch for potential downward revisions in delivery targets and margin forecasts if this trend continues into 2026. Next up, the broader electric vehicle market is growing, but North America just broke with the global trend. While global EV and hybrid deliveries jumped by 21% this year, North American sales actually slipped by about 1%. Tesla remains the U.S. leader, but this signals stiffer headwinds, domestic policy uncertainty, expiring credits, and increased competition from Korean brands like Hyundai and Kia, which saw sales surges of up to 30%. The takeaway? Tesla can't just rely on organic U.S. demand to drive revenue growth. North America now looks like a more mature, slower-growing market for the company. For long-term investors, this heightens the importance of international expansion and diversification of revenue streams, including energy and software. On the competitive front, Tesla is facing charged-up rivals from China. BYD continues to close the gap on global sales, and a new low-cost Chinese EV, priced below 50,000 reals, less than $10,000, is about to hit the Brazilian market. This isn't just a curiosity. Aggressive Chinese newcomers are redefining what value means in urban electric mobility, posing risks to Tesla's mass-market strategy abroad. For shareholders, the threat from ultra-affordable competitors could force Tesla into even more price-cutting, hitting gross margins and potentially prompting a rethink of the Model 2 roadmap or localized production strategies. Now, let's turn to manufacturing. Elon Musk recently visited Samsung's chip facilities in Texas, sparking speculation of deepening ties between Tesla and the Korean giant. Reports indicate Musk was there to discuss breakthroughs in semiconductor manufacturing for Tesla's proprietary chips. Why does this matter? As full self-driving (FSD) ambitions heat up, Tesla's need for advanced, high-throughput processors is critical. Leaks suggest Samsung may even set aside office space for Musk's team in their Taylor, Texas fab. For investors, this partnership could mean better in-house hardware for Tesla's AI and autonomy efforts, potentially a margin driver as FSD features roll out at scale. Back to the U.S. market, how is Tesla responding to flagging demand? The company is rolling out a barrage of short-term deals, 0% APR financing, inventory discounts, and stackable offers for Model Y buyers. Leaked internal memos hint at a significant increase in lease prices for 2026 deliveries, up to 67% higher than current rates. The hook? Tesla is sacrificing near-term pricing power to boost fourth-quarter deliveries, but investors should be aware that this strategy may pull forward demand, leading to an even steeper drop in early 2026, and puts further pressure on operating margins. Finally, sentiment around Tesla's business model is starting to shift on Wall Street. CNBC's Jim Cramer said it best: Tesla is transitioning from an auto company to a tech company. Investors are weighing not just vehicle numbers, but also the company's software, full self-driving, and AI value proposition. With Tesla pushing robotaxi ambitions and in-house AI chips, the story for 2026 and beyond may hinge less on delivery speed and more on whether Tesla can monetize its massive fleet as an autonomous platform. Keep an eye on Tesla's next software and autonomy updates and watch for analyst commentary. These are the new potential catalysts for the stock. That wraps up today's Tesla Daily News podcast. To recap, softening U.S. sales, cutthroat EV pricing battles, key semiconductor partnerships, and a strategic pivot toward software and AI are now front and center for Tesla's business outlook and stock price. Join us tomorrow for the latest on global market share data, next-generation battery updates, and any surprise moves from Elon Musk as year-end approaches. Subscribe for your essential Tesla investor briefing. See you next time.